And when we don't speak, we should mute, right?
Okay, and you're live now.
Good morning. This is Bruegel and our live stream event on corporate credit in Europe. I'm Nicolas Véran, Senior Fellow at Bruegel, also at the Peterson Institute in Washington. And it's my great pleasure today to welcome Colin Ellis from Moody's and Nathalie Berger from the European Commission, who will participate in the conversation in a few minutes. This is a live stream event. We will start with the presentations of Colin and comments by Nathalie, after which I will ask them some questions, and then we'll open it up to the audience. The audience will have the opportunity to ask questions through Slido. And Slido is an online tool that allows questioning with the possibility of stating your name or remain anonymous, depending on what you prefer. And we'll try to answer as many questions as possible. Our speakers are very expert speakers for this issue of credit in Europe. Colin Ellis has a very broad remit at Moody's that allows him to speak about different categories of credit, and he will come to it in a minute. And Nathalie Berger at the European Commission is head of the unit that deals with banking supervision and regulation, which of course is relevant for bank credit, but beyond that as well for a number of observations on corporate credit, sovereign credit, and other aspects, because banks are exposed to all those risks. So we look forward to a very rich discussion. I will continue holding the floor for a few more minutes to allow people to join us, and I will give the floor to Colin very shortly. Just to frame the topic of our discussion, credit, of course, means a lot of things in the current circumstances. The main thrust, the reason why we scheduled this session is that there are a lot of uncertainties on the impact of the pandemic shock in terms of how a number of obligations will be reimbursed or reimbursable in the short term, in the medium term, and in the long term. So there are many question marks in the credit space at this point. And obviously, credit rating agencies are have it as their live business to assess these things and to deal with the uncertainties, to assess what we know, what we don't know, what we know we don't know, what we know, to use the cliche, and what we don't know we don't know. So this is the core business of rating agencies. They have come under criticism, of course, in the previous crisis, particularly in terms of US structured products, but they remain, for the time being, the reference by default of the marketplace when it comes to credit risk assessment. I should mention on this that both Moody's and also their well-known competitors, S&P, are corporate members of Bruegel. We don't believe that creates a conflict in this conversation. And it's very clear that we have a space to disagree and we probably will have a number of questions in the conversation later on. But as a few minutes have gone, I think it's time to move on to the presentation by Colin, and hoping a number of participants keep joining us. So Colin, the floor is yours. I think you have a few slides, so I encourage you to share them on the screen. Thanks again for participating.
Thank you very much, Nicola, and good afternoon, everybody. I will now try and work the magic of Zoom, and hopefully you can now all see a few slides that we just put together just to frame my comments at the start of this. I should start by saying, again, a big thank you to Bruegel and Nicola and Nathalie for helping this event run. And also just to set out our perspective as a credit rating agency. Now, it's important to remember that we focus on largely the kind of traded debt in the market. So as Nicola said at the start, credit can mean different things to slightly different people depending on your perspective. for us, what I'm going to talk through here is really around how we're seeing the credit markets in terms of our ratings and the rating performance and the actions we've taken so far. But then we can broaden that out to talk about more general kind of issues as needed. And I have just a few slides that will be publicly available on the Bruegel website if you'd like them. And it's really just to kind of frame what we're doing so far, because as Nicola said, rating agencies came in for a bit of criticism during the last big crisis, 2007, 2008. And subsequently, of course, during some of the gyrations we saw in Europe afterwards. And if I had to summarize all of that criticism, I'd probably say that it was generally people thinking that we were too fast and too slow, and that ratings were both too high and too low. So I think for us, it's clear that we need to get out there and explain what we're doing and why, and how we respond to these kinds of events. So just to kick it off, this is a diagram we actually put together at the start of the crisis back in late January and February, just to spell out how pervasive we thought the coronavirus effects were likely to be in terms of their impact on the global economy. You know, we saw the demand shock happening. We also thought it was a supply shock. We saw the volatility in financial markets. And back at the start, really where we were trying to get to grips with COVID, it was also, of course, where we'd started to see some of the big falls in the oil prices. So it was pretty clear to us pretty early on that coronavirus was going to have a very pervasive impact across the world of credit. I should say, for those of you that are interested in more detail on this or anything else, everything I'm showing you today is published from our research, and all of our coronavirus research is free to access for everybody on our website. So if you want more detail on anything here, you can go there as well as ask us questions today. So there were a number of channels, which I probably won't go through here, but we saw a lot of sectors really seeing a big negative impact from this in terms of the impact of demand and supply and volatility. And a few where we thought there might be some positive effects, which were idiosyncratic to those sectors, but were probably going to be drowned out by the broader macro picture. And our view in terms of that macro outlook has just recently been updated. We updated our global forecasts on Tuesday with a new publication. And if I had to summarize that, I would show you this slide, which is basically lots of red. For our global forecasts, we focus on the G20 economies, which account for about 85% of global GDP. And basically on this slide, the more red you see, the worse the outcome is going to be for 2020. And this reflects the fact that, like everybody else, you know, it has been very hard to get a handle on just how much disruption we're going to see to individual economies over the course of this year, as governments, you know, rightly focus on saving lives first and foremost, and then probably gradually exiting from some of those measures that will have disrupted economic activity. And this macro environment matters. You know, what happens to growth, what happens to unemployment. These things really do matter for overall credit conditions for firms. But I think I just want to show you one more slide on our macro forecast, just to illustrate what's gone into our thinking about how we assess this. Because the profile we have for global growth looks a bit like this. You've got the G20 real GDP growth forecasts on the left-hand chart here, and you've got the level of GDP, which I think is often more useful when you're going through episodes like this, on the right-hand side. So what we have here is a very sharp fall off in activity in the first and second quarters in the right-hand chart that you can see, and then a relatively gradual resumption and recovery over time. So this feels to us like a short, sharp shock in the sense that the decline in GDP from peak to trough is very, very pronounced. And the recovery over time is short relative to past downturns in the sense that, you know, we're not seeing falling output for 6 quarters or more. We're only seeing falling output for 2 quarters at a global level. But it's not a fast recovery in terms of getting back to where you would have been, because we think there will be some permanently lost output. Global GDP will be permanently smaller as a consequence of this coronavirus outbreak. And that partly reflects the fact that there are some deadweight losses involved in an economic sense from a lot of the activities that are in place and from the disruption measures that are there. It also reflects the fact that as imbalances in the economy get pushed into the labor market, we know that takes longer to unwind. And we also expect some degree of probably shift in preferences, both on the part of consumers, but also on the part of businesses in terms of coming out of this crisis. We're not thinking that spending and saving will be unaffected, even when people get their jobs back and conditions start to normalize. And that in itself could take a long time. So we have quite a negative backdrop here, which underpins all of our ratings. And we still think, even on our new forecast, the risks are very much geared towards the downside. So, our forecast at the moment is not based on any kind of further outbreaks or new peaks in coronavirus in the second half of this year. We've allowed some bit of wiggle room in terms of the individual growth numbers, and we don't think we're going to be able to predict exactly when each country comes out at exactly what time and in exactly what way. But one of the things we've done is kind of push down generally on that recovery path, because we know that there's plenty of scope for things to go wrong, and that normalization process in the second half of the year to take a bit longer than we expected. So we have quite a negative backdrop. It's almost certainly going to be wrong, because trying to gauge the extent of the decline in output in Q2 is, I think, going to be really, really difficult. We even saw from the Q1 numbers this week that there were some quite striking figures already out there. But we see the risks to the downside as well. And that then presents the challenge for us in terms of, what does this mean for credit? And an important part of this is taking a view on what the governments have done to offset some of the economic disruption. So alongside the macro outlook and the risks that we see, the balance, we have also got to think about the support measures that have been put in place. And this slide summarizes some research we did focused on European governments, particularly the largest 5 European economies, and what governments have put into place. We think that the measures in general are supportive. Things like loan guarantees and providing salary replacement or furloughing, funding the cost of furloughing for workers, trying to get the credit support directly to some of the entities that really need it, relaxing some of the regulatory measures, giving banks scope to cope with things like mortgage holidays. In general, we think these things are helpful, but we do not think they're going to fully offset the disruption. If we did, we'd obviously have a less negative kind of growth forecast. One quick point just on the sovereign angle, and then I'll probably stop talking about sovereign unless we come back to it. Our view in terms of the cost of all of these measures is that they will have an impact on sovereign balance sheets. But essentially, particularly for advanced economies where they tend to have deep pockets, and of course they can rewrite the rules more easily, we're essentially giving governments time to kind of tell us what they will do to bring back debt dynamics onto a sustainable footing once we're through the peak of this crisis. We're not in a rush to suddenly downgrade lots of sovereigns here, because we know that there are support measures in place. We know that market yields are contained and debt is very affordable now for sovereigns. And rightly, the public sector focus at the moment is on saving lives. Now that could change, particularly if the crisis turns out to be deeper and longer than we had thought. But for now, I don't think we've taken any sovereign rating actions in Europe as a consequence of the coronavirus outbreak. That isn't true elsewhere, where we have taken some other rating actions, and we may get into a discussion around the IMF and G20 proposal around debt relief. But in terms of the European focus, we haven't done anything yet. And I think in general, while we can't rule out having to adjust ratings as we see credit conditions change and credit worthiness shift, it hasn't been our focus. But then the big question is, okay, what do you do with this and how do you do it? And I think our objective from very early on has been to try and be very transparent about how we think about these issues. Fundamentally, what we're talking about here is we're talking about businesses losing revenue for a long period of time, a great deal of uncertainty about the extent to which they're able to manage their costs so that doesn't feed through directly to profitability, and associated with that, normal concerns about funding and liquidity that we would expect in these kinds of conditions. So what we did back at the start of the outbreak was we kind of set out a heat map across different sectors for where we thought the impact of coronavirus would be most severe, where we thought it would be more moderate, and in contrast, those sectors where we thought the impact might be somewhat lower. And this is our corporate heat map for Europe, Middle East, and Africa. Obviously, our ratings are concentrated in Europe within that region. And there are no big surprises here. When you look at the red list, you have passenger airlines in there, which are clearly very much under the cosh. We have tourism, you have consumer durables and things like that. These were the sectors that we thought we wanted to focus on first and foremost because we saw the biggest risks. And in contrast, things like pharmaceuticals, packaged goods, food retail, those are the areas where we thought there would be less impact here from coronavirus. So at the start, we kind of decided to try and bucket and signal to investors in the market where we thought the risks would be. And ever since then, we have been conducting a trawl through all of our portfolios, looking at all of the ratings in all of these categories and assessing whether we need to move them or not. So to date, I think we've taken about 300 rating actions in Europe. We are publishing rating action summaries, which obviously we're about to write one for April, but we haven't quite finished April yet. And all of the detail will be in there. But if I can summarize kind of where we were a couple of weeks ago, this chart shows you where the rating actions have been taken according to those corporate sectors. And unsurprisingly, we've taken far more rating actions in those sectors where we saw the highest exposure and far fewer where we saw the least exposure. I do want to just emphasize one point here, though, because to us as a rating agency, a rating action doesn't mean a downgrade. It can mean a downgrade, but it could also just mean changing an outlook to negative or putting a rating under review. And it can also mean actually affirming a rating and affirming an outlook. Whenever we publish a rating announcement, even if it's not changing the rating or the outlook, that is still a rating action. So of the rating actions we've seen to date, actually about half of them, broadly speaking, haven't involved a change in the rating at all. So for around half of the corporate ratings we've taken a lot of them since the coronavirus started, most of those have not actually involved a change in the rating. Of the other half that have involved a change in the rating, about 80% of those, or 4/5 of those, have been a one-notch downgrade. So the response we're taking here in terms of the credit impact is really quite measured. What we're trying to do is we're trying to look through what we think is a very sharp, but ultimately short disruption. And we're trying to get a sense of what these corporates will look like on the other side. What will the damage to their balance sheets be when conditions resume? And of course, there are going to be some of these entities that don't make it. We've already seen some defaults in Europe. SoLocal in France was one of the first ones we saw, where there was a choice to not pay a coupon. And that's where the judgment for us is really difficult in terms of trying to get the balance right between where we are now, where we think we'll be in the future, and frankly, whether those individual issuers will get there without suffering a default. So we do have a lot of negative outlooks at the moment. We have a lot of ratings under review, and we're going to continue to come back and look at those and update investors as soon as we can. And then just a final point, because I know I've already gone on more than 10 minutes, which is really bad. We're not just thinking about the corporate sector. We're doing this across all of our rating franchises globally. So we're doing this for banks, we're doing it for infrastructure projects, and we're also doing it for structured finance. And we've taken this same approach of trying to identify high and moderate risks really across the whole portfolio. And this slide just summarizes where we see those high and moderate risks for our structured finance transactions. So one of the points you can see here for EMEA is our CLO sector, the kind of collateralized loan obligations. These are packages of lower rated corporate debt, essentially. And that's one sector where we do see some high impact, but really for the mezzanine and junior levels. Now, because of the nature of structured finance transactions, the senior notes should have more protection because of the way they're structured. We can get into this in more detail in the questions, but we're trying to link this all together. So of the corporate rating actions I just showed you, of the downgrades, most of those are in the speculative grade space. So, we are downgrading more single B credits because we're worried about how they will cope with a disruption to demand. We're less focused, the rating actions so far have been much less focused on the investment grade space because we see those credits as being more likely to make their way through this crisis and come out the other side. So this is our approach. This is what we're trying to do. We're trying to be as transparent as we possibly can. And with that, I think I will stop talking and hand back to Nicola.
Thank you, Colin. Thank you for a very good tour d'horizon to start with. I think you can unshare your screen so that we get back to normal mode. Thank you. I also need to make two announcements that I should have made at the beginning. One is that these slides are now available on the Bruegel website. So if you go to the event section of the website, you can get the slides and come back to them and also ask clarification questions. And my second point is precisely about those questions. We use a website called Slido, sli.do. You have that in the invitation. There's a code to enter the space for this event, which is simply credit, can be capital or lowercase, no matter. So the code is credit, and you can ask questions there. Actually, I already have a few questions, and I encourage you to ask more. You may name yourself, which is useful for us, but you can also remain anonymous on Slido as you prefer. Now, having said that, let me turn to Nathalie, and we're very keen to know what the Commission thinks of all that, and then start our discussion.
Thank you very much, Nicholas. Many thanks for organizing this important event and for having me on board. Thank you, Colin, for your very interesting presentation. I mean, we recognize in the slides that you have presented much of what we had seen on our side happening on markets. Of course, as far as I am concerned, I will focus on the action that can be taken in order to encourage bank lending in response to this. More generally, the Commission has really encouraged a coordinated response to the COVID crisis. So I will not enter into the detail of all the health-related measures, but I would like to focus really on economics and bank lending. We have been working just to set the scene in a very coordinated manner. We came 2 days ago on Tuesday with a public communication, a communication on the flexibility that is available to banks in the regulatory, accounting and prudential framework, with the objective, of course, to get banks to lend, to continue lending to businesses and to households. And at the same time, together with this communication, we have adopted a legislative proposal in order to proceed to some very specific, targeted, and I would say for the most exceptional and temporary adjustments to the regulatory framework. So if we look at the scene, and of course keeping in mind what Colin said about the situation on the different types of markets and the perspective, the situation today is really completely different than it was when we had the financial crisis in 2008 and when we had to save the banks and rescue the banks. Here we are facing symmetric shocks, and banks and financial markets are not at the origin of the shock, and they are to be part of the response. And so we are very much counting on banks to, first of all, be able to withstand the shock themselves, which is already something extremely important. The banks today are better capitalized than they were at the last financial crisis. They are much more resilient. They have strong ratios, strong liquidity ratios, and all this comes from the measures that were adopted internationally and within the European Union in response to the crisis. So we have improved capital ratios, and we have banks which have been in a position to build some very solid buffers. And I'm here also referring to the macro prudential buffers. So banks are much better prepared to withstand the shock. Still, we want them to continue lending to the economy. And on Tuesday, the ECB has also published their survey on bank lending, which is already quite interesting. So action has been taken at different level. I mentioned internationally, BCBS, I mean, there's coordination within the Financial Stability Board, and very much for us at European Union level, be it at the level of institutions or European bodies and the level of member states. So I just mention a few of the types of actions that we have seen. I mean, of course, first of all, the liquidity injection by the European Central Bank. We can think of the asset purchase program, the measures which have been taken by supervisors and notably by the single supervisory mechanism on capital, liquidity and operational relief. Just the fact that the stress tests which were scheduled to take place in 2020 have been postponed by 1 year does liberate some capacity for banks. I mean, an operational capacity that we would like to see really focus on the lending activity. The Basel, the final implementation of the Basel final standards is being postponed by the 1 year, and this also has an impact on what we are proposing to the legislator. And of course, at national level, we have seen some very important measures being taken. We have some state guarantees, we have some state aids, which are granted, of course, in the remit of the temporary framework for state aid measures, which was adopted by DG Competition by the Commission recently on the 19th of March. So we're trying to do what we can in the Commission to act in a coordinated manner and in a complementary manner to the monetary response and the injection of liquidity, and to the fiscal response and the fiscal policy of member states, so the relief measures that I mentioned. And I should also add to this, of course, the very important measures taken in some member states on moratoria and moratoria on loans repayment. You have in some member states action decided at state level or at a regional level. In other member states, the action is more taken by the private sector. So the rationale or our intention is to alleviate some of the burdens that are imposed on banks in a temporary manner. In a prudentially sound manner. We're not going to throw Basel through the window, of course not. So act in a manner that is prudentially sound, and at the same time liberate some space for banks to channel funds to businesses and households. There have been some debates about the impact of some rules on the provisioning needs of banks. And of course, this may then have an impact on their lending capacity or on the lending conditions that banks would have. However, at the same time, there is some flexibility which is available to banks. So I will just take a very simple example, which is the introduction of expected credit loss accounting after the last financial crisis and its possible pro-cyclical effect. And we've seen some action taken in the US on this. Well, we are taking action in the EU as well. We are communicating in our interpretative communication on the flexibility that is already permitted within the regulatory framework, and the fact that, for example, there should be no automatic mechanical application of the accounting rules, and that the banks have to make use of really of judgment. We have in the banking prudential regulation a transitional provision which allows banks to add back onto their capital a proportion of what they would be provisioning, and that's today 70%. We are proposing to the legislator to extend that transitional until the end of 2021 and to allow banks to add back onto their capital up to 100%. And we're also encouraging banks to make use of this additional capacity or this flexibility that is granted in the regulatory framework. We are also working on the issue, the very important issue of non-performing loans and the classification of non-performing loans. We want to make it clear that where there is a use of guarantee and state guarantees, there should be no automatic consideration of the obligor as defaulted. And we're also proposing to extend the treatment, to extend a favorable treatment to payment moratoria in the context of our regulatory proposal. I would say in exchange, we're also asking something from the banks, which is to exert some restraint. on the distribution policy. You have seen a recommendation by the ECB asking banks not to distribute dividends, and we're also very strong on this. So we are asking not to distribute dividends, and we're asking to exercise restraint in their general remuneration and distribution policy. So this is on the table of the legislator now, and we hope that we will be able to have a very swift decision process, and that the measures could be well in place before the next reporting dates at the end of June. Thank you.
Thank you. That was masterful and very comprehensive on the banking side. I have tons of questions, and we already also have a number of questions from the audience. So I'll mix my own questions and questions that have appeared on Slido. And I will ask you to make, to the extent possible, answers that are as succinct as possible, so that we can take many questions into half hours and that we have until the end of the session. Let me start with you, Colin. You mentioned the fact that the macro scenario and the general forecasting outlook that you presented was based on your latest update. Was the latest update more pessimistic than the previous update? You need to unmute. Yeah.
Yes. So you want a little bit more detail, I imagine, not quite that short. Yes, I mean, like everybody else, it has been hard to get a sense of exactly how big the disruption to economic activity will have been or is now in terms of those countries where we see all of these restrictive measures put in place. Businesses are shut, people are staying at home. And you know, we've had a few indicators around that. So wherever you get early data like the US unemployment numbers or kind of survey data or footfall on a weekly basis, you know, we are looking at lots of different data sources here, and we have a new monitor that looks at alternative data sources, which is exactly a collection of kind of daily indicators that can help inform this. But you're right. You know, our forecasts at the start of this crisis were not as negative as they are now, and I want to be clear. You know, we still see downside risks around the latest numbers. I think the thing that has maybe been to our advantage as a credit rating agency is, you know, although these macro numbers kind of set the scene for us and for all our analysis, you know, the fundamental questions around creditworthiness here are, you know, what do you do if your revenue collapses? How can you stop that feeding straight through to profitability by exercising cost control? And what does that do to your funding and liquidity? And those are fundamental credit questions. You know, they're not kind of economics or macro stuff. That's the kind of fundamental credit analysis that all of our analysts are used to anyway. And so although we had the macro picture framing what we wanted to do, for us, this has really been a very big bottom-up exercise. You know, we did that sectoral grouping to try and highlight where we were going to focus on first and second.
Right.
But this has all been, every rating committee, every rating decision is always about the individual company. And I think that's really helped us in terms of not having to rely so much on precise point estimates, which are very uncertain at the moment.
Let me provoke you for a moment. Is it fair to say that you and perhaps also other rating agencies have been erring on the cautiously optimistic side because there is a risk of, you know, creating procyclicality if you go with the more pessimistic impulses of the marketplace? So basically, you have to walk a fine path, a very narrow path between being overly optimistic, which would not be in your mandate, and being unduly pessimistic or just, you know, concerned that could create procyclical effects. Is that a fair description?
It's certainly a fine judgment for us, you know, and that call about, you know, fundamentally, do we think this individual firm, this individual credit will make it through this crisis with the support measures that are in place without defaulting? You know, at the end of the day, that's always what our ratings speak to, our default definition. That is a very fine judgment. You know, where we've done work in the past around this kind of pro-cyclicality question, what we've actually found is, you know, while ratings do exhibit a degree of pro-cyclicality, and you know, we could pick up on why in a moment if that's interesting, there's actually relatively little sign of ratings amplifying credit cycles. And it kind of comes back to something I said right at the start about the criticisms that we often get. You know, we're too fast, we're too slow, we're too high, we're too low. With these kinds of events, the market often moves long before we do.
Right.
And what we've tried to do is just take a very measured, gradual approach here.
And in any case, central banks have been applying circuit breakers both at the Fed and the ECB, right? Because they're not, if you downgrade an instrument to speculative, they still consider it legit, right?
Yes, absolutely. I mean, the central banks have made a policy choice that, where they see an issuer get downgraded out of investment grade, they will still consider it as investment grade for certain purposes. And for us, always and everywhere, we are thinking about the clarity of our signal. And we're always trying to respond to what we think are fundamental shifts in creditworthiness. So, we want to be careful, yes, not to be too optimistic, but also not to be too pessimistic. But one thing we absolutely want to avoid is having to reverse rating changes very quickly. So, we don't like either upgrading or downgrading credits and then having to reverse those actions a year or two later. And that's very clear from our data when you look at the performance of ratings and how they behave and how they contrast with kind of other measures of credit worthiness. One of the real things that stands out, leaving accuracy aside for a moment, is the stability of ratings. We really are trying to tell the fundamental story.
So I have a question on this on Slido, and we got a bunch of great questions on Slido, so please keep them coming. From Frederick, who asked, why are there massive downgrades? Well, he says massive. When there is a recession, if these ratings are meant to be through the cycle, you would expect them to be stable, no? So what do you answer to that?
Sure. So I think at first I have to challenge the notion of rating downgrades being massive. Again, most of our corporate rating actions since the start of this crisis, as I said, have not involved a downgrade. Of those that have, the vast majority is a one-notch downgrade. So, we're not seeing massive downgrades here. We are seeing an unusual amount of ratings activity relative to the number of rating actions we publish in any normal month or quarter. But I think, again, that's understandable given where we are. In terms of the through the cycle question, we try and focus on fundamental analysis. We try and focus on what does this mean for the issuer in terms of the credit risk over the longer term. So will you get paid on full and in time is the question we're asking ourselves all the time. And one of the difficulties here is it is possible to go through a recession and for that to do fundamental and lasting damage to your balance sheet. Now, it's less likely, that's less likely to happen if you're a strong issuer of your investment grade, but particularly for some of our weaker rated issuers who are rated single B or lower, and we have a lot of single B credits in Europe at the moment, right? Part of the fallout from the financial crisis is we saw this process of disintermediation where instead of going to banks, more medium to larger companies came to financial markets. For some of those single B credits, their continued access to finance in the market is very important, which policymakers probably can do something about. But a big collapse in the demand for their products, which we're seeing right now, is a fundamental challenge to them. And they may not have the resources to get to the other side of this without having to resort to some kind of default. So I think we do see some degree of co-movement in terms of the procyclicality of ratings. It is correlated with the credit cycle. We've seen that in the past. But in part, that's because you get more defaults right in recessions.
So let me turn to you, Natalie. A number of questions to you. First one is, as they say in Yes Minister, the calendar you have for the legislative process is very optimistic or certainly sunny. So do you think it really can be adopted by June? And is there any precedent in the history of EU legislative process?
Yes, Nicholas, you're asking a very relevant question, and I guess the response is not for me to give, but maybe more for the Parliament and Council. Well, what I can say is that we'll do all it takes to get to that result. We're having constant contacts with the Council and with the Presidency and with the Parliament. We've had some very productive informal exchanges before. I think what will determine the success or not of this quick action will be whether everyone remains really disciplined. We have focused our action, our proposal on a few number of very targeted measures, which should be impactful. This is not the moment to start, questioning the whole architecture of the prudential regulation, nor questioning whether we want to implement Basel or not. So we're staying very straightforward on that. I mean, the European Union remains committed to implementing Basel, I mean, to full, timely and faithful implementation of Basel, etc. So we're only having a few temporary measures which will preserve the soundness, the prudential soundness of the framework. And what we also do is to propose to anticipate the application of some measures which were already decided and adopted in the context of CRR2. But still, the fact of doing this, I mean, if successful, if possible, within the very short time frame, should really free a lot of lending capacity for banks.
What is the fastest ever that the EU co-decision process has lasted?
That's a quiz. I mean,
it's a quiz, yeah.
what I heard recently was that we have recently been able to adopt something very fast, but it's something which is nothing to do with the financial sector. So apparently, in the public health domain, there has been an adoption of a measure last month or this month in a very, very quick manner. So in times of crisis, sorry?
The EU can do emergency legislation after all.
We do.
Well, I have a question on Slido, which is about the temporary nature of the measures. What does temporary mean in relation with the legislative proposal presented? Is there a date for reversal of those measures?
Yes, and it's a very good question because I keep talking about the fact of preserving the sound prudential framework. So the measures that we propose to adapt will be circumvented to events that are in relation to the COVID-19 crisis. So, for example, when I'm talking about guarantees, I'm talking about guarantees which have been issued or granted in the context of the COVID-19 crisis. When I'm talking about the classification of an exposure as non-performing, I'm talking about an exposure which before the COVID-19 crisis was not a non-performing.
So basically the temporary thing is events driven. There is no date in the legislation, but it's linked to the pandemic.
Both. So event driven and date. So for example, regarding the transitional, which allows smoothing or the potential pro-cyclical effect of IFRS 9, what we propose is to extend that transitional by 2 years. So that would be for until
that's a Basel schedule, right? The Basel committee gave those dates.
Exactly. So we're aligned with the Basel committee, and for the postponement measures, we also follow the proposal of the Basel committee.
You mentioned IFRS 9. I don't want to enter into too much jargon. But I have a question about this also on Slido, which is the extent of application of IFRS 9 right now in the European banking sector. That's a question from Stefania. Where is it possible to find an overview of the European banks not using IFRS 9 because they apply national accounting standards? I think from anecdotes, there are a bunch of them in Germany. Is the Commission going to publish something that would allow the public to get a sense of that?
Well, it depends on the question. If the question is, are we going to publish this on a bank-by-bank basis? I'm afraid this is not something that we can do.
Well, it's public information, isn't it?
Sorry?
It's public information. It's just a matter of collating public information from individual banks, but their annual reports show if they publish on IFRS or not, no?
Yeah, surely, but there are also bodies in Europe that can take care of this. I mean, okay. I'm thinking of EFRAG, and I'm thinking of people who are maybe better placed than that. I am not in charge of accounting directly, so for the moment, I would need to check with my colleagues. I mean, maybe this is already published somewhere, but so I'll just need to check and come back to you.
There are little birds in Brussels who have been peddling the notions that the Commission had done very good analysis of that.
I'm sure they have.
If that becomes the matter of public information by the Commission, I certainly will read it with great interest. Not only speaking for myself here, you mentioned dividends, and that's obviously been a matter of a lot of attention also in the US. When you said the Commission is asking banks not to pay dividends or to exercise restraint, what exactly do you mean? Is that a recommendation? Is that something that you're offering as food for thought to bank management, or is there something more binding there?
No, I mean, we have the recommendation by the ECB, which is something that they can follow, I mean, in their supervisory activity, so that can be very strong. As far as we are concerned, this is really a message to the sector. It is a strong message to the sector, and of course there will be some monitoring as to the extent to which what we recommend is going to be followed. But for the moment, it is not, and it is not part of our legislative proposal. So there is no specific ban, for example, on dividends.
Colin, let me turn back to you with a question which is very emotionally loaded, but also I think very important for economic analysis. A number of senior political figures in the Eurozone, for example, French President Macron, Spanish Finance Minister Nadia Calvino, who is well known in Brussels and in DG FISMA, they have proposed this vision that because so much of economic activity right now is guaranteed by national governments, and the fiscal strength of different national governments, of course, is differentiated. That means that creates enormous distortions, competitive distortions in the single market. And that basically the single market can hardly withstand the tension that comes from these differentiatedly strong guarantees that are provided by differentiatedly strong governments, even assuming, which is not necessarily the case, that the specifications of the guarantees are identical from one member state to another. So how do you think about that? Do you, is it rating agencies have traditionally had a sovereign cap on bank rating? Are you applying a sovereign cap on all corporate rating? How is your kind of big picture thinking about these kind of things?
Okay, well, I think I'll start with the end of your question, and then we might have to circle back to the start of it. So we do have a house view at Moody's that sovereign credit risk is pervasive. And what I mean by that is if your sovereign gets into trouble, it's very likely that there will be credit distress experienced by a number of other issuers in that country. There are some exceptions. If you're an international business and your activity is not in the country that we're talking about, or if you have access to good funding and liquidity which is outside the domestic banking system, that can help. But by and large, it is difficult to be rated more than 2 notches above your sovereign. And that is true whether you are a bank or a company or an infrastructure project. Structured finance ratings are a little bit different, and that's where the concept of country ceilings comes in for us. But yes, we do have this house view that sovereign credit risk is pervasive. And in practice, that's because whenever we've seen sovereign defaults, we normally see a spate of defaults throughout the corporate sector as well, the private sector. So that is our house view. That has not changed. In terms of your broader question around the functioning of the single market, I have to be a little bit careful here because we're not allowed to give policy advice as a rating agency. I think the thing I would say is, yes, clearly we have differentiated sovereign ratings in the euro area, and indeed more broadly in the European Union, because the single market is not a euro area concept, it's a European Union concept. And that does speak to the different creditworthiness of those different governments. And that obviously would potentially filter through in terms of the impacts of cost of funding, access to guarantees, the support that we see there. But at the moment, in particular, given the role that monetary policy is playing, not just in the Eurozone, but elsewhere as well, the kind of classic sovereign distress concerns that people might have, particularly about market access and funding costs, seem pretty well contained to us. And that's one of the reasons why we're taking a very measured approach. We're kind of almost giving these sovereigns time to get on top of the health crisis, which rightly is their focus right now. Their primary focus is saving lives, and subject to that, trying to minimize the economic disruption that arises from that. but it's still true in the same way with a deposit insurance scheme for the banking sector. It's still true. You know, the backing of a AAA sovereign represents a different degree of comfort from the backing of a BAA sovereign, right? And that's true at the moment. I think in terms of the market distortion effects that you see, I think you probably have to tell a relatively complicated story there, which is conditional not only on the management of the shock by individual governments on both the health side and the kind of support side, but also the underlying distribution of creditworthiness within the private sector at the point the shock hit. I certainly wouldn't want to rule out the fact that there could be effects there. Whether or not they would be material in a relative sense and relative to the overall impact of coronavirus, I'd probably be a bit more surprised about that. And when you think about the overall degree of disruption we're seeing right now, before you get to some of these kind of guarantee-linked concerns about the functioning of the single market, that might be something that becomes more important on the other side of this.
So you find President Macron a bit dramatizing the issue?
I'm not commenting on any individual politician for many good reasons, because there are many of them out there. No, it's right that policymakers try and think about all of the possible side effects and issues that arise from this. Often there are underlying agendas, and often there are compromises that need to be made around these policy choices. And I think we recognize that, and that's one of the reasons why we're happy talking about the credit consequences of a policy choice. But we try, as far as we possibly can, not to tell people what we think the right thing to do, or if you want to think about it that way, is we don't give policy advice.
There's a related question, but which is separate, which was asked on Slido by André, which is we'll evidently see differentiated exits from lockdown, and we already see that. How does the timetable of exit affect the way you look at credit?
Yeah, that's a really, really good question, because, you know, at first glance, you could say this is a pretty symmetric shock in the sense that it's hitting lots of people all at once, and it's the same underlying issue. But actually, we've already seen an asymmetric response, and we're already seeing asymmetric impacts. You know, the bottom line is we're going to get to the other side of this, and sovereigns are going to have more debt, and size of their economies are going to be smaller than would otherwise have been the case. And if you thought that was pretty uniform across the sovereign rating universe, or at least the group that you cared about, that might not matter that much for ratings, because of course ratings are a rank ordering concept. So if every country in the world ends up with debt to GDP 10% higher and associated effects, that are all perfectly symmetric, you know, that becomes, you know, a fairly difficult exercise to then think you can differentiate on that basis, which is what we try to do. The reality is, different sovereigns will come out of this with more or less damage to their economies and more or less damage to their balance sheets in terms of debt loads. And that is exactly the kind of thing that will have to feed into our sovereign rating analysis. Now, what I would say is, I think we will continue with our pretty measured approach here, because particularly for higher rated sovereigns that have good market access and deep pockets and, you know, large economies, certainly in a per capita sense, even if the absolute size isn't that big, you know, we tend to want to give sovereigns a bit of time to see how they will adjust to the shock and how they will kind of manage things over the medium term. So somebody coming out of this maybe 3 or 6 months before their neighbor, but the kind of macro impact being broadly similar, I'm not sure if that would have a differentiated credit impact in our view. You know, we'd have to sit down and look at it. But if you see, you know, some countries come out of the other side and the fiscal cost has been much lower and the debt burden already has a plan to be reduced and the economy bounces back very quickly, versus another sovereign where, you know, there's no plan to reduce debt and the resumption of economic activity is very slow. Yeah, clearly that second example is more negative for the sovereign credit rating than the first. But that's the kind of thing we will have to judge when we start to see that unfold. I think it's too early now to make judgments about, you know, what the exit path is going to look like, particularly from taking a rating, you know, moving credit ratings. But it's exactly the kind of thing we will be considering.
Natalie, turning to you, you have mentioned also flexibility and capital relief and a number of accommodations that the Commission and more broadly the EU authorities, including the ECB, have been granting to the European banking sector. the delaying of stress tests, moratoria, a number of other things. There's been a thought-provoking note published by, I think, Autonomous Research a couple of days ago, arguing that, you know, maybe there's a point where it becomes too much. So there's a point where granting more relief sends a message to the marketplace that there actually is a problem in the banking system and that they're not able to make it through the other side of this without extraordinary support and public forbearance. What do you make of that? What is the point when a lot of relief becomes too much relief?
Well, thank you. Well, I would look at this from a slightly different angle, because the relief that has been granted is a very targeted type of relief. And because banks continue to publish their results. And I mean, no later than yesterday, I had a big bank sending me some information on their results, which were still very good. And I think they intend to communicate on this. So again, it's a question of finding the right balance and targeting the aids and the moratoria. And of course, then it's a question of banks effectively channeling what they receive to the real economy. And this is also something that is going to be monitored by the supervisors. So I would hope that everything would be balanced. And I don't think that we are at the stage where we risk going too far and where we would risk having an impact on the way that investors would perceive banks. And for that one, if I may, notably the point on the restriction of dividends. I mean, we understand that some banks were initially a little reluctant with communicating on restricting dividends, because they were concerned that it may have an impact on investors' policy regarding, of course, them. And for that reason, it was helpful to all that there was the communication from the ECB SSM, and that this was framed in the regulatory framework. So we understand, and we had that reaction from several banks, that they would have no problem in doing it, provided that the source was something published by the Commission and recommendation by the authorities.
That's right. And yeah, go ahead.
So, sorry, I think I could not emphasize how important it is to have a very articulated and coordinated response. And I think all the response to your question lies in the coordination.
And I was going to mention that Stuart Graham of Autonomous, who was the author of the note I mentioned, has been quite supportive of the limitations of dividends that the Commission and the ECB have been signaling. So there is no contradiction here. And to mention a personal opinion, I think it's indeed a very fine line to walk. I mean, between providing enough flexibility and going too much into the direction of forbearance, which we know from experience can be very harmful when the banking system becomes zombified, as we say in jargon. Maybe a question. We're getting towards the end of our session. It's almost on an hour, but I'd like to ask a last question, which is relatively narrow but important to you, Colin, which is about NPL deals. Before the pandemic hit, we saw a very active market for NPLs. Actually, I remember 3-4 years ago, there was a discussion about market failure on NPLs. And actually, we saw no market failures in the last 3 years. We've seen a lot of deals and the ability for banks to divest a number of non-performing loans to private investors. I noted that in your last slide, NPL securitizations were deep in the red. So how do you look at the NPL market in the current circumstances? And do you think that banks that have a lot of NPLs on their balance sheet, say the Greek banks or some Italian banks, will be able to offload them or won't be able in the foreseeable future? How do you look at that?
It's a great question. Thank you, Nicola. Yes, NPLs are very much in the red bucket. And indeed, I think just last week on the 24th, we downgraded or placed on review, I think, the ratings of at least 12 notes in some of the Italian NPL deals that we rate, because NPL it's pretty sensible to allow banks to have a slightly different treatment of NPLs that arise as a consequence of mortgage holidays now. It does still pose the question of how do you deal with that over the longer term? At the end of the day, there are going to be costs from this crisis, and they have to be borne by someone. And that's the kind of thing that we will be thinking about and talking about. But again, to emphasize and agree with Natalie, we think banks come into this in a much stronger state than they did the global financial crisis. Capital levels are higher, liquidity is good. So it was starting from a very different place. In terms of the market, we have seen the market for kind of higher risk issues and things like that obviously kind of dry up a bit with the crisis that we've seen right now. I mean, there's a bit of a gap here between what we've seen in the US a little bit, certainly in the corporate space, between high yield and Europe. Investment grade markets are still seem to be functioning, but anything that's a little bit more exotic, anything where you need the buy-in on the whole structure of a securitization, so not just the senior notes, but also the mezzanine and the junior, it is going to be more difficult. But again, if we're right, and this is a relatively short and sharp downturn, even if the recovery is slow because the extent of the fall is so big, maybe you might see some of that market activity come back a bit quicker than you saw, at least in Europe, after the last downturn, where securitization levels in Europe, on a very general basis, haven't recovered anything like they did in the US after the global financial crisis, even coming into this downturn. So I think there's a levels effect. I think there is some market disruption right now, but ultimately we're just going to have to wait and see. And it will come back to the crucial thing that held up some of these deals in the first place, which is about agreeing a price. What price will the banks accept for offloading some of these NPLs, and what price are investors prepared to pay? What's happening right now, you would expect to maybe drive a little bit of a wedge between those two perspectives here right now. That's not a market failure, that's the market working. But you need, if that gap does widen, you need it to close again for this to resume.
That was very elegantly put. We're getting to the end of that session. I have a few takeaways. I have very much got the message that the Moody's approach was measured and that the EU approach was coordinated. That all makes me very optimistic. Actually, I get a sense of cautious optimism from both presentations. I think it will be very interesting to see in a couple of weeks or months' time how the outlook has been evolving. Of course, I hope, but don't predict that this optimism will be warranted. So we'll continue monitoring that. It's a big area of emphasis for us at Bruegel to get a sense of the credit outlook, not in a structured way like rating agencies, but with the tools we have. And I'm very grateful to both of you, Colin Ellis at Moody's, Nathalie Berger at the European Commission, and to all our participants in the audience, which have been very engaged also on Slido, and of course to the supporting team at Bruegel, Katja Knežević, Matilda Sevon, and everybody else for organizing this. So thanks very much, and have a good afternoon, rest of the day if you're in the US like me, and hopefully see you soon. Thanks very much for attending this session. The session is adjourned.